If you are holding SCHD in your portfolio right now, I need you to stop whatever you are doing, because the next few minutes could be the most important of your entire financial year. Not your week, not your month, your entire year. We have all seen the headlines: market volatility, interest rate uncertainty, dividend ETFs under pressure. But here is what nobody is telling you. Something massive is happening behind the scenes, and by March 2026, the very foundation of the Dow Jones U.S. Dividend 100 Index is scheduled for a shift that most retail investors are completely ignoring. While everyday investors are glued to their screens watching stock tickers, smart money, the institutional players, the hedge funds, the pension giants, they are quietly dumping 3 specific sectors before the next major market correction hits. Today at Liberty Wealth Academy, we are not just scratching the surface. We are going deep. We are breaking down why your $10,000 investment might not yield what you think it will. We are exposing what smart money is doing right now. And most importantly, we are showing you exactly how to position yourself for what we are calling the 2026 dividend gold mine. Stay with me, because what you are about to hear changes everything. Section 1. The SCHD Reconstitution logic. Let us start with the most important question. Why March 2026? Why is this date so critical? SCHD is not just a random basket of stocks that someone threw together. It is a ruthless, emotionless algorithm. Every single stock inside SCHD must pass 4 brutal filters: cash flow to total debt, return on equity, dividend yield relative to peers, and most importantly, consecutive years of dividend growth. If a company fails even one of these filters, it gets thrown out. No exceptions, no sentiment, just cold hard data. Now here is where it gets interesting. The economic cycle of 2024 and 2025 put enormous pressure on what we call old economy stocks: rising input costs, shrinking margins, debt levels that ballooned during the zero interest rate era now becoming impossible to service. Companies that looked rock solid in 2021 and 2022 are quietly bleeding out. By March 2026, many of these legacy companies that previously sailed through the SCHD screening criteria may no longer qualify. We are talking about names that retail investors have trusted for decades. Names that people hold in their retirement accounts and IRAs. Names that are about to be shown the door. This means the SCHD you own today might look dramatically different in 24 months. The holdings could rotate significantly. The sector weightings could shift. And if you bought based on today's composition, you could be in for a very unpleasant surprise. Here is what smart money is doing in response. They are not panicking. They are anticipating. They are moving early, rotating into high-quality growth dividends. Companies with clean balance sheets. Companies with expanding free cash flow. Companies with dividend growth rates that outpace inflation by a significant margin. We are entering a phase in this market where yield on cost, the dividend you receive relative to your original purchase price, will be the only thing that protects your retirement from the silent destruction of inflation. Not your nominal yield, not your portfolio balance on paper, your yield on cost. Remember that term. It will matter more than almost anything else over the next 5 years. Section 2. Smart money is dumping these 3 sectors now. Let us talk about what the whales are actually doing. Because institutional investors do not wait for a crash to happen. They do not watch CNBC and react. They move early. They are always 2 steps ahead of the headlines. And right now, the data is showing a massive and systematic exit from 3 key sectors of the market. Sector 1. Commercial real estate REITs. With interest rates remaining higher for longer than almost every economist predicted, the cost of debt is absolutely crushing smaller and mid-sized players in commercial real estate. We are heading into what is being called the 2026 debt maturity wall, a period where hundreds of billions of dollars in commercial real estate loans come due simultaneously. Many of these loans were taken out at 3% and now need to be refinanced at 7% or higher. The math simply does not work. Smart money saw this coming 18 months ago and has been quietly reducing exposure ever since. If you are overweight commercial real estate REITs right now, you need to pay very close attention to what is happening in this space over the next 12 months. Sector 2. Stagnant consumer staples. These are the companies that household investors love. The boring, stable, dividend-paying giants that have been in portfolios for generations. But look closer at what has actually happened. Many of these companies aggressively raised prices during the 2022 and 2023 inflation wave. And yes, their revenue held up on paper. But their volume, the actual number of units being sold, collapsed. Consumers traded down to private label. They changed their shopping habits. They pushed back. The dividend is safe for now, but the growth story is effectively dead. And when dividend growth stalls, SCHD algorithm eventually notices. Smart money is rotating out of the weakest names in this space before the Reconstitution forces the issue publicly. Sector 3. Legacy energy. The energy transition is no longer a political talking point. It is now backed by institutional capital at a scale that is impossible to ignore. Green energy infrastructure, nuclear power, which is experiencing an extraordinary institutional renaissance, and next-generation grid technology are attracting serious long-term money. Meanwhile, old-school coal operations and inefficient high-cost oil extraction plays are being systematically rotated out of major portfolios. This does not mean all energy is bad. It means the specific names that cannot adapt are being quietly abandoned. If your portfolio is heavy in any of these three sectors, you are not diversified. You are concentrated in exactly the areas that institutional money is exiting. And when the big money leaves, retail investors are typically the last to find out. Section 3. The $10. 000 dividend reality check. Let us get brutally honest about something that most financial content creators will never tell you because it is not exciting enough to go viral. $10,000 in SCHD at today's yield of approximately 3.5% generates $350 per year in dividend income. That is less than $30 per month. That is not financial freedom. That is not passive income that changes your life. That is a few cups of coffee and a streaming subscription. And yet every single day, content across the internet tells people that dividends are the path to instant financial freedom. They are not. Not at $10,000. And the sooner you understand that, the sooner you can build a strategy that actually works. Here is the real power of SCHD and high-quality dividend growth ETFs. And this is where Liberty Wealth Academy parts ways with almost every other channel in this space. The power is not in the immediate income. The power is in the dividend growth rate. SCHD has historically grown its dividend payout at approximately 10 to 12% annually over the past decade. Think about what that actually means in practice. If you invest $10,000 today at a 3.5% yield, you receive $350 in year one. But if the dividend grows at 11% annually, which SCHD has demonstrated it can do by year 5, that same $10,000 investment is yielding you significantly more on your original cost basis. By year 10, the compounding effect becomes extraordinary. Your yield on cost begins to snowball in a way that most people simply cannot visualize when they are staring at today's yield percentage. The goal of $10,000 in SCHD is not to pay your rent today. The goal is to plant a seed that grows into a machine capable of paying your rent in 2030, 2031, and every year after that without you doing anything additional. That is the real strategy. That is the long game that smart money plays while retail investors chase high yield traps and get burned. Conclusion: your 2026 roadmap, the opening months of 2026, are going to separate two very distinct types of investors. The emotional investors who react to headlines, chase yields, and make decisions based on fear and short-term thinking. And the strategic investors who understand the underlying mechanics, position ahead of known catalysts, and treat every dollar as a long-term asset. To be in the second group, here is your concrete action plan. First, watch the March 2026 SCHD Constitution closely. Pay attention to which names get added and which names get dropped. The additions tell you exactly what smart money's algorithm currently rewards. The deletions tell you what is being abandoned. Second, audit your current holdings against the three sectors we identified today. Commercial real estate REITs under debt pressure, stagnant consumer staples with declining volume, and legacy energy that cannot compete in the new institutional landscape. Reduce exposure where it makes sense for your specific situation. Third, and this is the most important mindset shift of everything we covered today, stop treating your $10,000 as income. Start treating it as seed money. The harvest comes later. The machine gets built over time. The investors who understand this in 2026 are the ones who will look back in 2031 with extraordinary results. Now I want to hear from you. What is your top dividend stock or ETF pick for the next 2 years? Drop it in the comments below. I read every single one. And if this breakdown gave you even one new insight that you are going to act on, hit that subscribe button and join the Liberty Wealth Academy community. Every week, we bring you institutional-grade analysis without the Wall Street gatekeeping. Your financial future is being built right now, one decision at a time. Make it count.